Hey everyone, me Kevin here. It was 9 days ago that I posted a YouTube video titled Going to Cash. And boy oh boy, a lot of things have actually gotten worse since that video. In this video, we're not just going to remind you that structural CPI and PPI has stagnated against many people's expectations, which is a problem, but we're going to save that because we already know about that. We're going to focus on some big issues and what Wells Fargo, Goldman Sachs just warned, both of them together, and I'm going to show you another chart that's a little scary. But before I do that, I want to just quickly show you what the heck happened after I shorted Tesla. I was not expecting to make a 50% return on my put on Tesla. Now, if you're part of the Stocks and Psychology of Money course, or really any of the courses, not only do we go live every morning where we talk about my strategies and the trades that I'm making, you're welcome to join those at meetkevin.com, but the Stocks and Psychology of Money one gets all of my notifications for when I actually input these. This was a trade here I made 50% on within 24 hours. I was blown away by this, partly because the market really took a little bit of a beating today. And I think the beating the market gave us today is just a warning, an early warning of what Goldman Sachs is actually warning us about. In this video, we're going to reveal how they're actually telling you to start buying hedges, and they're going to tell you where to buy those hedges. So we'll talk about that. But first, I want to make a correction because I made a little oopsie doopsies. I showed you in my Going Short Tesla video the Goldman Sachs financial conditions chart. Well, my notes were based off of this chart right here. However, the on-screen image was an old image. That was my fault, and I was moving the mouse around an old image using what was in my mind of this data. Now, it amazingly aligned the same. That's why I didn't catch it, but the fact of the matter is the same, but I'm going to correct it because when I make a mistake, I am going to tell you I effed up, and we're gonna fix it. Because that's what you got to do. Everybody makes mistakes, and you got to fix your mistakes. So what do we have here? 2024. You can clearly see we go out to today over here. And what I want you to notice is the plummeting, absolute plummeting that continues to plummet in the Goldman Sachs Financial Conditions Index. Now, this is a combination of VIX, stock prices, bond prices, real estate, you name it. It is basically a way, credit availability. It's basically a way of saying, hey, how easy is it to get money or to basically, do things when it comes to finance, whether it's banking or otherwise. And again, it incorporates market conditions. And so that's why as the market was rallying after the stimulus explosion throughout the COVID period, you have this massive period of low Goldman Sachs financial conditions. This makes sense. But what I want to do right now is I'm just going to block this section out because we know when helicopter money is coming, obviously, you're going to have low financial conditions. So let's block out when we're literally handing out money to people for a moment. I think that would be reasonable for us to do. I know some people are like, whoa, don't make changes. No. I think we should realistically get rid of that. Now what I want you to do, because you can get a clear picture of periods of time where, yes, we may have had accommodative monetary policy like quantitative easing, we didn't have blunt stimulus checks, right? So you go back and how low are financial conditions today relative to history? Well, the start of COVID was one. All right, well, we know that was all related to COVID and panic, so let's cover that one up. All right, so what do we have outside of COVID in terms of financial conditions? Well, we have a low in 2018, and we have a low in 2014. Those were periods where inflation, and I want to be very, very clear about this, inflation was averaging, folks, 1.7%. That's why the Federal Reserve came up with the lie, although I guess as they say, it's only a lie if you don't believe it. It's not, in other words, put another way, it's not a lie if you believe it, right? Dang it, and I believe it. I bought it hook, line, and sinker. But anyway, they had this accommodative policy of, we just want inflation to average 2%. And the idea was really, what can we do to prop up this 1.7? And so we had these loose financial conditions in 2014 and 2018, which are supportive of low inflation. But what do we have right now when we look at the recent 3-month measures of core inflation? Well, we're sitting really between 3 to 3.5% of core inflation. This is bad, and numbers are coming in worse, not better. And again, there were a lot of people who were like, I saw the second wave coming. And who knows, maybe this second wave will only be a 3 to 6 month blip and it'll all go away. But I'll tell you, there are a lot of people who didn't see the second wave coming to a lot of an extent, myself included. I was not expecting to see a second wave that was this sticky. We expected owner's equivalent rents, for example, to just be an anchor that would bring down inflation. I did revise my opinion to think, okay, it's going to take longer to go away, but maybe the line won't be straight down. It'll be a little bit more flattened out. That is sort of something like this. You get a little wider of a path down. But the problem with that is that's not happening either. You're actually getting a reignition of inflation, and this is bad. And this is what's leading now Goldman Sachs and Wells Fargo to give us big warnings about what might come next. So let's address that. The very first thing we get is a warning from Wells Fargo. And the warning from Wells Fargo is very blunt. They call it the self-defeating prophecy of lower rates. And I wrote, yeah, this is really bad, basically. But listen to this. Right here. In recent public comments, Atlanta Federal Reserve President Bostic recounted informal discussions with business leaders who were, quote, ready to pounce at the first rate or hint of an interest rate cut. Wait a minute. Ready to pounce at the first hint of an interest rate cut? Boy, doesn't that sound familiar. That sounds like basically everybody who's ready to buy electric vehicles, solar products, houses, expand their business, take up financing, move cash to stocks, basically pile everything in as soon as rate cuts start. Well, that's a big red flag to the Federal Reserve because some people, might not want to wait for that. A lot of people might be, all right, we're ready. We're getting close. All right, aim. A lot of people are like, screw it. Boom. Let's go. Let's spend. Well, that props up the economy. It's one of the reasons we have the Atlanta Fed real GDP measure, which did come in lower today. It came in at 2.3%, but it's still well above where the Federal Reserve expected we would be this year. Most expected that this economy would expand maybe 1 to 1.5% this year, and it's actually expanding more. Part of this is potentially because the Federal Reserve has been shouting, yes, rate cuts will come eventually, for the longest period in history. At no point in history have we ever talked about rate cuts for this long. We've been talking about rate cuts since before rate cuts started. It's scary. And so that's actually been propping up the economy because what's happening is people are just spending through it. Well, that defeats the purpose of what the Federal Reserve is trying to accomplish. It's sort of like, I'll buy a house now because I like that house, and I'll just refinance when rates come down because we all know they're going to come down. Well, that self-fulfilling prophecy defeats the whole point of having rate hikes in the first place. Well, as a result of that, Wells Fargo suggests, hey, we're going to push back our penciling in of rate cuts. But in my opinion, they don't go anywhere near far enough. Look at this. They say this does push the timing back somewhat, especially because inflation numbers are incrementally higher in the back half of the year. We now have 4 rate cuts penciled in for 2024, with the first occurring in June rather than May. I read this and I'm like, what are you absolutely smoking, Wells Fargo? And it actually makes me concerned that you have people on Wall Street who are looking at what the Federal Reserve is saying. The Federal Reserve is saying, look, 3 rate cuts. Okay, at the beginning of the year, with how low inflation was plummeting, I totally agreed. We're probably going to get more than 3 rate cuts. Probably. Okay, but this piece is not written at the beginning of the year. This piece is written this week after we've gotten multiple structurally higher inflation reports. And so, again, at the beginning of the year, if you thought, yeah, we'll get more rate cuts than 3, fair game. Now, for you to argue we're going to get more than 3 rate cuts, you really have to think something's going to break. Wells Fargo here does not indicate something's going to break. They think the Fed's just going to basically have 4 rate cuts in the second half of the year. No frickin' way. My opinion is that we should actually be at the opposite side. If they told us 3 at the beginning of the year, when inflation was almost cured, I mean, we were ready to declare victory, basically. If they were at 3 then, they're probably at 0 to 2 now. There's no way you're still sitting at 3. And obviously, we're going to get the rugging on the 20th of March, which is just 6 days away, which is also summer surgery day. But anyway, it's crazy. March 20th is going to be a problem because I think you're going to get a Fed that's going to remove at least 1 rate cut in this one. And then they're going to see how the market responds. And guess what they're going to do next? In June, they can rug you another rate cut away. They don't have to go incrementally super bearish to absolutely destroy the economy. They could simply go, all right, it's the March SEP meeting, let's get it down to 2 rate cuts. And then in May they hold, and then in June they don't cut either, and they go, let's get the forecast down to 1 rate cut. and just see how the economy does. Is the economy still doing well? Are jobs still holding up? So far, jobs are still holding up. But you know what's not holding up? Delinquencies. Now, this is a nominal figure, but even if you factor in inflation, this figure is 40% higher than the nominal figure before the pandemic. Inflation, if you assume inflation is 30%, we are now above delinquency rates on all loans and leases to consumers, credit cards, and all commercial banks by at least 10 percentage points compared to 2019. That's inflation adjusted. You've gone from 22.7 over here in billions of dollars, now to 32.1, and guess what? It's going straight up. Now, that's actually a scary line. Why is this so freaking scary? Because look, usually you have the saber tooth over here, where it's like it goes up, it comes down, goes up, it goes down, and then you have to draw a trend line. I don't need a trend line over here. This is nasty enough. It's basically vertical. Now, I know there's some normalization here, but this is not a year-over-year percentage comparison. This is nominal millions of dollars. Now, we can change it. We could easily change it to a percentage comparison, which is fine. And what do we see? Well, the percentage, the rate of increase is higher than what we've had in '08, but I usually don't like doing that because you did come out of a period where it was basically impossible to have defaults, right, post-COVID. So I like this millions of dollars comparison, and we're basically skyrocketing like we did during the recession and right after the recession. Kind of weird, but it's something to pay attention to. This straight line usually happens in oopsie-doopsies times. And what is that leading to? Well, it's leading Goldman Sachs in part to say, oh dear, it's time for some hedges. After all, we have Goldman Sachs here giving us 3 risk factors. They suggest the S&P 500 is at all-time highs and we have exceptionally low volatility measures. This has a large potential for a near-term drawdown. What a great day for it to be March 20th, but Goldman Sachs thinks it's more likely actually to be April. Who knows? Everybody's guess is as good as anybody else's, supposedly. Anywho, the second risk they provide is a tech drawdown risk. Now, the tech drawdown risk is simply that tech stocks have rallied over 50%, and essentially there are plenty of cheap options to hedge yourself with some of these really elevated tech names. And then, of course, you've got tech risks or just Chinese risks in general regarding election catalysts leading to potentially higher volatility with stocks with exposure to China. Okay, well, where else do you have exposure to China? Well, nobody really cares about NVIDIA's exposure to China anymore because what's happened? Well, NVIDIA's exposure to China has just basically, frankly, turned into doesn't matter. It just doesn't matter because, well, you have so much other money coming from AI. But there are plenty of other American companies that have exposure to China. Apple, Starbucks, Tesla. Some of these companies get 15 to 30% of their revenues from China. So yes, Chinese risks are actually real in the American economy as well. And this is absent like China invading Taiwan. Another potential risk, and this is really just sort of like a little sidebar tangent, but there's a fantastic piece today about in Bloomberg, actually, about from Bloomberg economists here, who suggest that there is a flood of electric vehicle production in China. And although this flood of electric vehicle production in China, making new cheap EVs and sort of blowing up how many EVs are produced, probably won't affect the American market directly because we essentially prevent these Chinese vehicles from being imported in America, which there's a limitation to that, right? At some point, if we can have a lot cheaper cars by importing Chinese stuff in the future and we have better relations with China in the future, Chinese cars will come flood America at some point in the future. But that doesn't matter so much. What matters is the competition you're creating in all the other auto markets. So again, take a company like Tesla, they're competing directly in both Europe and China, as well as other places around the world with Chinese EV makers. And China is stimulating the snot out of these. Now, remember, Tesla was one of the few companies who negotiated that there would be no Chinese ownership of the Shanghai Gigafactory. That's really rare. Usually, the Chinese Communist Party partners with corporations in China. But during these boom times, they really wanted Tesla to build out the infrastructure for their own EVs so they could basically, well, compete with Tesla, right? It's like using your enemy to make your own stuff a lot better. It's kind of what's happened. And then no surprise, some of the expansions of Shanghai have started to stall a little bit in favor of other companies getting subsidized like BYD. Now, what's fascinating here is having a partnership with China sucks in good times, but it's good in bad times. Times are bad right now for EVs. So, no partnership, no subsidy from the Chinese government for Tesla. Oopsie doopsies. But anyway, this is just an example of how China can affect you. But the Goldman Sachs team actually recommends you buy volatility index call options for April, expiring at $16. Now, I don't have a position in the VIX. I might open one. If I do, I'll send an alert to all the course members in the Stocks and Psychology of Money group. Even if you don't want the course content, you just want to be part of our course member live streams where we do fundamental and technical analysis every morning. Right after I close the market morning live stream, I go right into it. We usually do 30 to 40, 45 minutes on average of Q&A, deep dive analysis. You want to be a part of this. It's a really great way to enhance the changes that we're seeing coming. So check that out by going to meetkevin.com. That's also where you'll see a link to the Millionaire Symposium event, which is expected, well, it's happening June 21st to June 23rd, and it is happening in Vegas. So Ben Malo will be there, I'll be there, Ross Gerber will be there. We've got some more speaker announcements coming as well, so we're super excited to share those with you. And anyway, going back to Goldman Sachs here, they're recommending volatility calls, mostly because they think the VIX should go to 21.5. Well, I want you to see what the VIX looks like right now when we go over to Webull. So jump on over to Webull, and what do you have? Look at that trend. That is a little bit of an oopsie doopsie. Why is it an oopsie doopsie? Well, because you've got this perfect downward channel. We're probably in the lower 30% of that channel, and it's probably primed for a run-up, especially if we do end up getting that rugging from the Fed. Now, by the way, I use this platform for trading as well. Oh, look, my P&L this morning, or today, on a crap day too, is up 24.6%. That's great. The market was pretty red too. But anyway, if you want to use this platform, go to metkevin.com/Webull, and you'll get up to 20 free stocks worth between $3 and $3,000. Some of them could be fractional, some of them could be full. So check that out by going to metkevin.com/Webull. They're a partner of the channel, and we love Webull. We use them every single day. So if you haven't used them yet, metkevin.com/Webull. I'll link it down below as well. So we've got Wells Fargo freaking out. We've got Goldman Sachs showing us this chart. I mean, look at this. They're suggesting that current levels of the volatility index are sitting here. I'll move myself. There you go. Are sitting right here when their models indicate we should be sitting at the red dotted line. And if we get any kind of Jerome Powell shock, we should be up here at the red dots. So there is potentially an opportunity to make a move on a VIX play. Now, you can't play it directly through the VIX. You'd have to use something like, I like to call it SVXY. That's SVXY. That is the inverse of this. Now, this starts getting a little tricky, so it's really a topic for a different video. But if you wanted calls on the VIX, you'd have to buy puts on SVXY, SVXY. Remember, indices you can't directly invest in. You have to use a proxy, like you invest in the SPY to get exposure for the S&P 500, or you invest in QQQM if you want to invest in the NASDAQ 100 index. The M is basically the cheaper version of QQQ, and it's the same thing, essentially. So read their prospectuses. It's not, none of this is financial advice. Keep that in mind. I am a financial advisor, but none of this in this video is personalized financial advice. We talked about my sponsor, and I think I'm pretty transparent here with my positions, no VIX positions, although I might open one tomorrow. I did close my Tesla short. I expect likely to reopen this, but I do think after a 4.12% drop today, I think there's a good chance we're going to get a little bit of a green bounce tomorrow, which might be the perfect time to go short again going into Monday, Tuesday. Obviously, it's trading. But the other thing to look at too is look how sensitive tech is right now, and this is scary. Adobe in after hours, which isn't even on that chart yet, plummets 10%. Why does it drop 10%? Well, it drops 10% on a barely miss. This was ridiculous. Adobe slightly missed on their forecast. They actually beat on their earnings, and they slightly missed on their forecast net revenue. And what happens? The sucker's down 11%. That's not even fair. Why though? because things are probably a little overvalued. You want to know a company that beat across the board, and then you want to know what happened to the stock? Ulta. Ulta beat across the board, but they made one mention suggesting that beauty has gotten more competitive. And even though their guidance was in line, their indication that beauty was getting a little bit more competitive, despite beating, was enough to send this sucker down 6.7% here in after hours. That's crazy. Why is this happening? Well, it's happening because these stocks have gone to crazy all-time highs. Look at them. This isn't sustainable. This is the week chart for Ulta. Now, we're going to pull that right back down to 527 in after hours right here. So you have a red candlestick going down to my mouse over there tomorrow. But who cares? Look at this sucker anyway. It's crazy. It's all gone straight up. That actually increases earnings sensitivity. And that is particularly what makes me actually more nervous about a company like Tesla. The more sensitivity you have in the market, the more even a slight miss can absolutely destroy a stock. And this is one of those times where, I mean, just look at the greed or fear index. I love doing this, okay? You look at greed or fear index. You know how they say be fearful when people are greedy and be greedy when people are fearful? We are just barely off of extreme greed right now. Market momentum, extreme greed. Stock price strength, extreme greed. Stock price breadth, which means the number of stocks going up, extreme greed. Put and call options, the ratio between the two, greed. VIX, neutral, although it's neutral at a low level. So frankly, that should be greed. You've got, junk bond demand at extreme greed and some other levels. This is, I love it when I see people, they're like, oh, Kevin told us 9 days ago he's going to cash, and then he sold some positions. And people are like, oh, he's just fearful. Really? The entire market is full of freaking greed. Absolutely full of disgusting, illustrious greed. Call me when the sucker's back at extreme fear, and then I'm going to take my cash and plow it in. But we ain't there right now. And frankly, I think there is a real possibility, unless the economy crashes, which if the economy crashes, rates are going to get cut really fast. No doubt about that. But as long as GDP and jobs stay the way they're moving and inflation keeps doing this nonsense where it's structurally stagnating, we might get rate cuts this year. For those of you listening, that's 0. Yeah. I mean, think about what we got. Inflation whacked us over the last 3 months. J. Powell removed FATE, and there's no jobs recession. So it's like, and I mean, the banking crisis is somewhat limited. Yeah, I mean, there are problems in the banking crisis. Look, I've been reading about this as well. Fewest banks posting earnings gains since 1997. A lot of this could be based on the fact that FDIC is trying to claw back money from all the expenses they had during the banking crisis of last year, so they're trying to get some of their money back. So there are definitely issues we want to pay attention to with the banking crisis, and I'm watching it very closely, especially now that the Bank Term Funding Program, the facility, has closed. But holy smokes, I don't know, man. I just want to be so transparent. And I know people are like, wait, how could you change your opinion? Well, the true supporters of my channel realize I change my mind when the data changes. When the facts change, I'm not here to say everything I do is perfect, but when the facts change, man, bye. It's very simple. I do the same thing in business, and that's very, very important. If something's working great, I'm going to keep doing it. If I got a great deal in real estate with househack, I'm going to pursue that sucker until I close that deal, and we're going to rent it out. And it's going to be beautiful, stabilized building. If the facts change and some seller is trying to defraud me, and they're like, oh yeah, it's 2% vacant, and then I actually do my due diligence and it's 30% vacant, F you. I'm not buying your crap anymore at the price we agreed to because you changed the facts. Everybody should do that. Everybody. Do not get emotionally attached to things. If you want to learn more about my housing startup, by the way, go to metkevin.com / I'm sorry, no, it's not a metkevin. It's househack.com /2024. If you're an accredited investor, you can invest in the startup, and then we are responding to all the emails that we're getting for people interested in the mini fund 1031 option that will be launching soon, which is really kind of cool, and that'll be a precursor to essentially enabling people to 1031 from real estate into a stock, which is insane that you can do that. Kind of wild. Anyway, thank you so much for watching. Let me know what you think in the comments down below, and we'll see you in the next one.